Hello, everyone. Welcome to ELI, the only podcast in India where we bring a new founder on every episode to talk about their journey and their story of building a startup. And today we have with us Raghavendra Nath, who is the managing director at Ladderup Asset Managers, which is a private wealth management firm handling investment of Indian family offices and wealthy individuals. Hi, Mr. Raghavendra. Welcome to ELI.
Yeah, yeah. Thank you, Priyaranjan. Glad to be on your show.
To start with, can you introduce yourself to our audience? Tell us a bit about what you guys do. What's the company about?
Yeah, so Priyaranjan, we started Ladderup Asset Managers in 2011. So, 2 months back, we completed 14 years.
Wow.
It's a journey which feels as if we started only yesterday, So while it's almost a decade and a half, and
Mm,
it's been a very very interesting journey because when we started with almost no clients and no business. Today, Ladderup Asset Managers is amongst the top 100 firms in India in terms of size and operating across multiple asset classes and managing hundreds of clients.
mhm,
So the journey has been pretty good and exciting, and we have been able to create a niche for our kind of people, and
mhm.
I'm sure as we go along, we'll discuss the different aspects of wealth management firms and different kinds. And we have found our niche, and we want to continue to operate in that niche as we go along.
Absolutely.
Yeah. So it's been an exciting journey, actually.
Before we start talking about Ladder Up, would love to understand about your personal journey before entrepreneurship. I think you worked for Aditya Birla and other companies in asset management and other such
Yes.
industries. Can you tell us about that?
So I started my journey, in capital markets in 1994. I had just graduated from my MBA school, and I majored in finance. Having done engineering, I thought that's probably the way to go,
Mhm.
because I was a little bit inclined towards, these. Sorry, just give me 1 second. So inclined towards the capital markets, and related concepts. So
Mm,
1994 is when I started, and that was a very interesting year actually. So because SEBI had been formed just a couple of years before. Okay,
yes.
so SEBI was formed, I think, in 1992. And SEBI brought in a lot of changes in the way capital markets operated. And one of the first things that they did was ease norms for listing of equities in India. Okay.
Mm-hmm.
And so it becomes much easier for people to access capital markets. And that led to a big flood of companies which wanted to basically raise money from the public.
Mm,
In any case, that period prior to that, a few years prior to that, we had had that Harshad Mehta saga and all that, and
right.
it had told, at least it had whatever negative aspect is one thing, but I think first time in India, people got to know the power of equities and how it can transform lives.
Mm-hmm.
So when this new listings started, there was this new phenomenon of companies which were coming and accessing markets, and clients who were willing to basically invest into those companies, seeing an opportunity. So that was
Mm-hmm.
a time when I started, and I joined a merchant bank because that was one of the more very interesting area activity, because merchant bankers were really doing well. There were hundreds of
Mm-hmm.
merchant bankers in India, everybody helping various companies to access capital markets.
Mm-hmm.
So did that for 2 years, and then I joined Birla Sun Life Mutual Fund because that capital market activity continued for 2 years. But as it always happens, IPO markets basically tend to do really well, and then something happens, one or two IPOs bomb, and then it
Mm-hmm.
cools off. So I think that was 96 was a period when that cool off happened, and I joined Birla Mutual Fund. And in fact, mutual fund industry was also a very nascent industry. I think the total size of the industry was only 3-4 thousand crore. Birla had 500 crore of AUM and only
Mm-hmm.
two funds when I joined in
Okay.
1996, and we were just a 45 people team. And I was entrusted with developing the northern region. So I went there, started setting up distribution and talking to investors. And so it was a very exciting period in my career because first time I was doing sales. I had
Mm-hmm.
always been a finance guy, and I was talking about a concept which people had not heard and people did not believe.
Okay.
And so it because prior to that, mutual funds were always sold like FDs. So
Mm-hmm.
SBI had a mutual fund. They had these plans called Magnum and all that. Canara Bank had a mutual fund. BOB had a mutual fund, and they were sold through bank branches. Saying that this is new kind of FD which can give you
Mm.
higher returns. So people did not actually understand the concept of mutual funds for a very long period of time. So
Right.
96, 97 is a period where the private sector funds started making inroads, and Birla was one of the pioneers in that respect. And
Mm.
so we had that first mover advantage, plus also the challenges which are associated with first mover advantage, which every founder will probably relate to. So it very exciting period. And then around 2002, I moved to the corporate office and started heading the investment strategy function. So I became the
Mm-hmm.
head of strategy and marketing, and which gave me an opportunity to think differently and launch products which were missing in the Indian landscape. So started various concepts like the first dividend yield fund, the first bond index fund, the first mid cap fund, the first
Mm-hmm.
asset allocation fund. All these were launched by me, and again, it was quite exciting because every time I launched a concept, I'll travel across the country talking about why that concept is a good idea, to basically include in the portfolio and what kind of clients can invest into those. So it basically not only enhanced my learning experience, I also contributed to the learning experience of the industry, you know.
Mm.
So 2011 is when kind of I thought that why not, basically entrepreneurship had always been in the back of the mind. So I thought, let me just take the courage and go out into the open and set up something which could be useful to people and also can give me that sense of satisfaction and achievement.
Got it. One question here. I think you were leading the new product development and you were launching new products catering to India market. And this job is, if you ask me, almost similar to a entrepreneur's job. Why
Yeah,
did you, think of, coming out of the comfort zone of being an employee, getting good salary to
yeah.
something uncertain, which may work, may not work, comes with a lot of risk. Why would you try that?
For me, I think it was the job. Obviously, it was exciting, and I could create a lot of things. But s- at some point in time, actually it becomes a little repetitive. You're doing the same kind
Mm,
of thing again and again, and probably. And I had actually, if you were to ask me, that period between 2002 and 2011 was also the period of maximum learning for me. Because I was traveling to various countries. I was understanding what kind of products were being launched there. I was studying the Indian market, studying consumer behavior, and then basically designing things. So it was
mm,
also a period of great learning. So I thought, why not basically utilize that learning to kind of do something, because I saw a gap in the offerings as far as the wealth management businesses in India were run. And I saw
mhm.
that there is an opportunity out there to kind of capture that, segment, which is basically offering high quality wealth management solutions to people. And that's the
Okay.
reason why for me to take that leap of faith.
Okay. And when you started out, how was the market? Who was managing the funds of these wealthy people? Was there a established industry already, or do you sort of, like you always did, come up with the new products, new ideas? Did you just start out a new sort of industry, or was it already there?
No, it
And
was.
you,
And wealth management industry has been around for decades actually, and it's in some form or the other. Okay, so obviously, as time has passed, the industry has also become more sophisticated, more matured, more number of players have joined. But one interesting thing about Indian market is that wealth management industry in India is very, very fragmented. Okay.
Mhm.
So when I started, since mutual funds is the largest industry in India as far as wealth management tools are concerned or products, there were 80,000 registered ARN holders, AMFI registered number, people who had registered with AMFI and they were doing some business or some kind, or at least they had registered. There were 80,000 of them, So, and then there were, all the banks, almost every single bank in the country, right from private sector bank to public sector bank to, those small regional banks, everybody had started offering wealth advice to people. So it was
Mhm.
a very, very crowded industry then, and it's a crowded industry right now, So uh, we were not kind of doing something new, okay, when we started, but we could see that there are gaps, and we
Okay.
wanted to take advantage of those gaps and create a proposition which becomes which can create good value for our customers or potential customers. That was the idea.
Got it. And speaking of gaps, what gaps did you observe?
So generally, if you look at, okay, first of all, the biggest gap in the country, if you look at as far as wealth management industry, is that there is no quality control. There
Mhm.
is no regulatory oversight on the quality of advice being dealt out. Okay. So anybody who can clear a few exams, which are not very difficult to pass, you can just study for maybe a few weeks or maybe get a little bit of coaching for a month or two, and then you can clear those exams. Okay.
Mhm.
Now, but just clearing that exam does not make you a wealth manager, because when you're dealing with somebody's wealth, it is his hard-earned money of his lifetime till now. Okay. So if I'm 40 years of age, let's say, or and whatever wealth, let's say you have certain wealth, okay, which you have accumulated right now through years of hard work. Okay.
Mhm.
And this wealth is going to accompany you for the rest of your life. Obviously, we'll keep adding to this pool every year, more and more. And as the years pass, the amount of wealth that you will add to the pool will also keep increasing. But the pool as it exists today is important to you. It cannot
Mhm.
be replaced. The wealth that you have already earned and accumulated cannot be recreated. Okay. That time is past. So it's very important that the solutions that you get are of adequate quality.
Mhm.
If let's say you end up dealing with somebody who doesn't have understanding of capital markets, who have not seen market cycles, who doesn't understand the risks of investing, there are chances that you may end up investing in places with information which was very little or superficial. And when let's say, and if things start going wrong, neither you nor your manager may know what to do with it.
Mhm.
Now, when you look at it, this at a country level where there are tens of thousands of advisors, but there is no benchmark in terms of quality, it
Mhm.
creates a problem. Okay. So it's only a chance that you may end up meeting a good wealth manager who can protect your money, who can give you right solutions, who can stick with you for long term, who doesn't do any mis-selling to you. He doesn't take
mm,
any shortcuts. He monitors all your investments, guides you at every step. And so he becomes like your trustworthy partner. Like you have a
mm,
family doctor, he becomes your wealth manager for life. Okay. If you're
mm.
lucky. If you're not lucky, you may find a wrong person and then another wrong person and then another wrong person, and probably you will lose trust after
Right.
a point in time and say that no, I just don't want to deal with these people because they are only going to do a shoddy job. you know
Got it.
Now when you have an industry which is where there is an opportunity to create a platform or a practice where you can assure clients that no, that job will not be shoddy, it will be always thorough, and
Mm,
we always act on your behalf and not with self-interest, and this is how we are going to do it. Then you have created a proposition which is quality. So even in a crowded industry, it is possible to stand up and create a place for yourself. And
got it.
not only us, Ladderup is just one name. There are hundreds out there who have had the same philosophy, and they have also created a proposition. Because for a country of 140 crore people, and maybe out of this, maybe a few million people will be wealthy individuals, you need lots of people to advise. One person cannot solve that problem.
Got it. And speaking of trust, I think you rightly mentioned India doesn't have enough quality fund managers. Just anyone can just pass a exam and become a fund
No, no,
manager.
fund managers are different. Wealth managers are
I'm
different.
sorry.
Yeah, there's a
Wealth
big
managers.
difference. Yeah.
Got it. My bad. So and you rightly said people do not trust easily because there are not enough quality and good wealth managers in India. How did you as a company convince your customers? How did you acquire the initial clients who usually do not trust and you don't have a portfolio to show when you started out? How did you
So
gain
it
their
was
trust?
more about so you have to see, I think, and this will be true for every founder and every person. When you are starting in a new job, when you are starting a new firm, you have to put your credibility on the line. Okay.
Mm,
And so only then people can believe what you are saying. Okay.
mm,
And thankfully for me, I had this very rich experience behind me. I don't think there is anybody in the industry today who has worked in so many diverse, basically, places over last 20, 30 years. And even
got
when
it.
I started, I had almost 14, 15, 16 years of experience. But that experience was a very rich experience, which had taught me a lot of things. And so when I communicated with prospective clients about the things and ideas that I want to implement and how I want to implement them, I think people were ready to give that chance. And it's like
Got
that, I always tell our team members, when you are selling something, you can't expect 100% results. You are selling an idea here or a concept here. If you
it.
talk to 10 people, two people will talk to you or will believe you. If you talk to 20 people, four people will believe you. So you just, rather than getting disappointed by one person or the second person, you just keep going, keep talking to more and more people, because there'll be people who value the idea of a good advisor.
Mm-hmm.
Okay. Because ultimately, so as we discussed, there'll always be that lack of trust, because it's very easy to build dreams, isn't it, or to show dreams to people. So
Right.
if I, let's say, come to you as and start, let's say I'm a wealth manager in XYZ company, and I come and talk to you and I say that I've done this and I've done that, and see market has driven such fantastic returns in the last 5 years. Sensex has grown 3 times. I pick up a best performer. I say, see this fund I recommended 5 years back. You don't know whether I recommended that or not.
Hmm.
Okay. You don't know how many people basically bought that fund when I recommended it 5 years back. Okay.
Right.
So it's very easy to kind of give a story to you which is believable. And
Hmm.
when everybody is telling the same story, then who do you believe? So there are 10
Right.
people who come and every person says that my story is the best story and the truest story. So
Hmm.
how do you base? So mistrust becomes automatic in this business. So
Right.
you need to go beyond just telling a story when if you have to kind of tell and convince a client. Obviously, there'll be people who will get convinced with that story and invest, you know,
Hmm.
because they have met only one person or the first person that they met, they got excited and therefore then they invested. But serious investors, people who have a lot of money, people who have burned their hands multiple times looking at these stories, then they want more. They want a philosophy. They want how this philosophy will remain consistent over a period of time. You know, what kind of investment rigor is this? Can this person have? You know,
Hmm.
he can do that day after day or week after week. Does this
Right.
person have fair amount of intelligence or not? Does he have fair amount of maturity or not? Is he also concerned with losing money as much as I am concerned about losing money? You know, so if you most conservative people and most wealthy people are conservative, you know, in fact, most people, human beings by nature are conservative. We want to avoid risk. Okay.
Hmm.
Nobody wants to put their finger in a fire or to hold a hot pan, with bare hands. We want to avoid risk.
Right.
When that is inherent to our nature, then you need to basically figure out ways and means to then manage that risk properly.
Got it. Uh, Curious to understand one thing. Where do these HNIs or family offices invest, and how is it different from the people like the normal middle class people who would invest in a mutual fund or a stock or a derivative? How is it different?
So I'll tell you, the instruments become different, okay? And this is something that people have to understand. Fundamentals of investing has never ever changed. They have not changed in the last 200 years. They'll not change in the next 200 years. And what are those fundamentals? When you are giving money as a loan to somebody, that person should have both the capability as well as the willingness to pay back.
Mm.
Okay. When you are investing in a business, in an equity share, you are actually buying a portion of a business. So
Mm.
if unless the business does well, the share will not do well. Because the price of the share is only the reflection of the quality and the size and the growth of the business.
Mm.
Okay. Now, these two fundamentals will remain the same. When you're investing in real estate, it's people say there are only three things in real estate: location, location, and location. You know,
Mm.
because demand and supply is going to drive the prices in real estate. When you're investing in gold, demand and supply will guide the prices of gold. So when you're investing in gold, you need to see whether the demand for gold is going to be more in the future years or supply is going to be more. When you're investing in real estate, so considerations across asset classes are same.
Mhm.
Now the instruments change. So somebody may say, no, I am not interested in investing in listed equities. I'm interested in investing in the startups. But
Mm.
again, when you're investing in startups, what is the underlying belief that this is startup, which is basically maybe creating X revenue, is going to create 100X revenues after 5 years. And if this X goes from X to 100X, then my investment will also grow from 100 rupees to, let's say, 10,000 rupees or whatever, or 5,000 rupees. So,
Mhm.
so the fundamental is the same. The instrument may become different. Mutual funds today, people say are boring, like you also mentioned. Middle class
Right.
people invest in mutual funds, rich people invest in AIF. But what is
Mm.
the underlying in both the products? In both portfolios, you have underlying equity shares.
Right.
Okay. So it's not that AIF can produce better return than a mutual fund, fundamentally. For both a mutual fund manager to beat an AIF manager, he needs to have a fantastic strategy, or he also has to have a high quality, high growth portfolio. If the AIF manager wants to beat from mutual fund manager, he needs to do the same.
Mm.
So both of them are operating in the same space. So whether you are investing in AIF or PMS or mutual fund, all of them, as long as they are investing in listed equity, they are investing in the same space. They are doing the same quality of research. They are creating similar portfolios. Okay.
Mm-hmm.
So if say you say that mutual fund will give me less return, PMS will be, we are just wrong. If a fund manager comes because I am a PMS manager, I can produce better returns than mutual fund, he is wrong. He is not telling the full story. Okay.
Got it.
Because ultimately there are differences. For instance,
Mm-hmm.
PMS manager may be managing 500 crore. Mutual fund manager is managing 50,000 crore. Okay. The guy who's managing 500 crore has far higher flexibility. He doesn't have impact cost. He can take far quicker decisions. He can
Mm.
get out very quickly from stocks. He can change his portfolio very quickly. He can react to the market news and risks and everything very fast,
Mm-hmm.
which a fund manager with 50,000 crore portfolio may not be able to. So there
Got
are
it.
certain differences, but they are qualitative differences. Having these advantages does not make a PMS manager give you better returns. For that, he will have to use these advantages in a positive fashion.
Mm-hmm.
He did not, then it creates risk for you. So he may actually underperform the mutual fund manager who is maybe having a far more longer term view, stable portfolio, lesser churn, but he's also investing in high quality.
Got it.
So,
So what I gather from here is the high net worth individuals, they have higher degree of risk appetite, and they can
no,
okay.
yeah, no, please complete your question. And
Yeah,
then
and hence they can invest for a longer term, and they can expect a better return because the risk is higher, return would be definitely higher.
so two things. Okay, so first you are saying a high net worth having high risk, and then high risk, high return. Okay, so let us deal with both. First of all, 99% of wealthy people are risk averse.
Mm-hmm.
Okay, 99. There'll be 1% who has this thought process. I have so much wealth, so what is there to lose? Let me speculate or let me take high risk. 99% people will say, I have so much wealth. Why do I need to take risk?
Mm-hmm.
Okay. If I grow this wealth by 7%, 8%, I'll still be good. In fact,
Mm-hmm.
I'm making far more than what if I by investing in equities, I'm making 12, 13, 14%. And I was good even with 8%. So most people in the world are conservative. Nobody wants to lose wealth. In fact, the more wealth that you have, the higher becomes the risk of losing it or a portion of it. Okay.
Mm-hmm.
So let's say I and this is something that I encounter every now and then. Okay. We have a lot of investors who are high net worth, they have large portfolios. Client says, oh, I should have sold earlier, I have lost 5 crore.
Mm-hmm.
Okay. And I say that no, but that's only 5% of your portfolio. And 5% volatility you have to keep in your stride. Markets can go down 5, 10, 12% any day.
Mm-hmm.
So instead of looking, you see what is happening here. The thing is that he's not looking at the percentage, he's looking at that absolute amount, 5 crore, which is substantial.
Right.
Okay. And that is what makes them risk averse. For them, that 0.5% means a large sum of money. 1% means a large sum of money. In case of a normal average middle class investor, 1% may mean only 1 lakh rupees or 2 lakh
Hmm.
rupees. So for him, actually, the amount of money, because his aspirations are high, is still small. Because he may have 1 crore today, but he's dreaming of having 20 crore.
Hmm.
Okay. So when he loses 1 lakh, it's not a very big sum.
Got it.
So I have seen, and in my experience, retail investors have far higher risk appetite because they want to get wealthy quicker. You
Hmm.
know, they want to quickly multiply their money. They want to get richer faster. The rich people who already have enough money also develop patience and create and develop risk aversion. You got
Got
it?
it.
And the second thing that you talked about, higher risk means high return. It's not, it's actually high risk only means higher volatility of return.
Hmm.
So let's say you go in a bank deposit. You said, I'll only invest in bank deposits. 1 year back, bank was offering 7.5%. Today, he may be offering 7% because interest rates have come down, or 6.5. Okay.
Hmm.
And let's say if the interest rates were to go up, that 7.5 may become 8%. So the
Hmm.
volatility of the return is only 0.5% here and there.
Right.
When you invest in equity market, you are saying, okay, I can get 15%, I can also get negative 5% or plus 20%. So the volatility
Hmm.
of return has become higher. When you invest in private equity, you may lose money. Your money can become 500% or it may become zero.
Hmm.
So the volatility of return is higher. So when you take higher risk, the risk has to pay off for you to basically get higher returns. Otherwise, you can have a setback. So when we say manage your risk or control your risk, that is what we mean that, okay, you are taking higher risk with the assumption that this is going to lead to higher return. But if the risk showed up, okay, that higher risk, basically today you are not taking that risk. No, you are saying thinking that higher risk investment can have certain uncertainties. If those uncertainties don't happen, I'll get higher return. But what if the
Hmm.
certain uncertainties happen? Then are you prepared to basically take that loss in your stride?
Hmm.
And that is the how you should basically look at having a low risk or a high risk. A high risk
Got
investor will not blink an eye if he has lost 20% of his wealth.
got it.
Okay. A low risk investor will panic if he basically loses 5% of his wealth.
Hmm. Got it. And here is my final question before we close. How do you foresee the future of Ladderup, and especially considering the new technologies that are coming into picture, like Robo-Advisor? AI is here, where it can, consume a lot of data and advise you, which stock to invest, which company is going where. So effectively, they're reducing the number of manpower required to analyze stocks, to advise these individuals who have extra fund to invest in. How do you foresee the future? What would be the role of these wealth advisors, and how do you, as a company, investing in technology?
So, Priyaranjan, first of all, I think that some of these changes are already visible in the last 4 5 years,
Yes.
where apps have made an appearance. You can open a broking account in 2 minutes, and then you can start trading. But there are advertisements on mutual funds. Sahi hai, go for direct plan and save that 1%. Everybody is offering these do-it-yourself solutions.
Hmm.
Okay. So we are already in that phase where digitization and technology is basically making inroads in everybody's home. Okay. And it will happen more and more. AI will accelerate that pace. The point is that there are people, especially people who have lesser amounts of money, who cannot afford a good wealth manager, or who are unable to find a wealth manager, because good wealth managers are across the country. Even in the smallest town, you may find a very, very wise man who's a wealth manager and who can protect you and grow your money. Okay. So it's not that it's only in Bombay and Delhi. But if you have not found, then you will end up basically doing that. The point is that risk management is something which is not a concept, which is a defined concept. Okay.
Hmm.
Because who knew that Israel Iran will get into a problem? Did anybody knew that Pahalgam attack will happen in February,
Right.
in November? You know, can anybody predict when will be the next big earthquake in India? When will there be a tsunami in India? You know, so
Hmm.
they could be. Risk is something which has not appeared till now and which you have not thought about, and that event happens. That is
Hmm.
what is risk. When those things happen, okay, you don't know where to go because everybody was giving you advice only to make money.
Hmm.
How to protect, nobody talked, and you also never thought.
Right.
Unfortunately, in India, we have had a 15, unfortunately, fortunately, actually, touch wood, it continues. We have had a 15-year long rally. The last crash that happened was in global financial crisis in
Hmm.
2007, 2008. You know, we are now in 2025, which is almost 15, 16 years. You know, in COVID time, there was a correction, but it was a blip. In
Hmm.
March, market corrected. By July, August, market had already retraced 50, 60% of it. By December, fully.
Right.
Okay. So people have not seen bear markets in last 10,
Hmm.
15 years. And in 15 years, India has grown some 4, 5, 6 times as a GDP, and people's wealth have grown by 10, 20, 30 times.
Hmm.
And this large mass of people have not seen bear markets at all.
Hmm.
So when bear markets happen where you don't make money for 5 years in a row, 4 years in a row, let's say after 3 years, you are still seeing a 50% loss in wealth. If I were
Hmm.
to paint a scenario today, and this happened in 2000, if you had 1
Right.
crore of rupees, it had become 50 lakhs in 2001. And then it remained 50 lakhs for another 3 years.
Hmm.
Just imagine if this were to happen in stock market, Sensex goes from 85,000 to 40,000, and then it remains 40,000 for next 3 years. What will happen?
Right.
That is where you need quality wealth managers. So it's like doctors. Whatever
Hmm.
AI can come, if you were to get operated on your heart, will you trust a robo or will you trust a doctor?
Correct. Got your
Same
point.
is with your wealth. Heart, you can still trust a robo.
Hmm.
If wealth, you trust a robo, you have lost 30, 40 years of hard work. Okay.
Hmm.
You just Google how many hedge funds have just gone bankrupt in the world. And they are
Hmm.
the ones who had all the rocket scientists, NASA engineers working for them. How many of them have got? You'll be surprised. So when an institution can go bankrupt with which has employed thousands of people, and all those thousand are brilliant minds, then anything can happen to anybody. So that's where basically that wealth manager is like a guide, like spirituality, you go and see guru.
Hmm.
That way you need to have a wealth manager who can be with you for the journey that you are undertaking from now onwards. In whichever stage of journey you may be, you may be an early start. That then also wealth manager is good. And if you are already wealthy, in any case you should have a wealth manager. So
Got
I
it.
think this business is never going to go out of vogue.
Understood. Understood. And fairly said. Well, on this note, we will close the session. Thanks for joining us, Mr. Raghavendra. It was a pleasure to have you on our platform, and our best wishes for the product and the company that you are building.
Thank you, Priyaranjan. It was glad to be here.
Thanks. Thanks.